Hi, everybody. Thank you for attending. My name is Michelle Fitzpatrick. I am joined here today with Sarah Starling and John Starling. We are going to be presenting 1031 exchange basics. Just so you know, this is going to be recorded. So if you don't feel comfortable being recorded, you can log off now, but you can know that we'll be sending this recording out after the session. So by staying on, you are consenting to be recorded. So without further ado, I'm going to pass it over to John and Sarah, and we're going to get started. One more housekeeping item. If you have any questions, you can do one of a few things. We're going to be monitoring the chat. We're going to be monitoring the questions and answers, but you can feel free to, again, unmute, turn your camera on, and ask a question outright. We're going to be talking for about 45 minutes, and then we're going to leave about 15 minutes at the end for questions and answers. Thanks so much.
Hey, okay, so I'm John Starling, and I've been involved in exchanges and exchange work for individuals and corporations for about 25 years. Sarah, to my right, is my daughter, and she is a certified exchange specialist, has been involved for what?
14 years.
14
Yeah.
years. So we've been working as a team with Michelle for over 10 years now. And we're just really enjoying our association with Northern Bank and Trust, and the name of our company called Northern 1031 Exchange is a qualified intermediary, which is an established name by the IRS. And you have to have a qualified intermediary in order to perform an exchange so that you can avoid paying tax on the property that you are relinquishing. So just to get
started on our first slide.
Yeah, let's just get started on our first slide. So Sarah, you want to talk about the code?
So let's just start right from the beginning, and we can discuss the actual language. And 1031 is a code in the IRS system, and this is the definition of that code. And it reads, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. So we have that real in green because you can only 1031 exchange real estate, investment real estate these days. Personal property was axed out of the code during the Trump administration. So we're lucky to still have real estate.
It's called the 2017 Tax Reform Act. And now we cannot exchange businesses or heavy equipment or rental fleets, things like that. And real estate, though, is, of course, still very actively involved in the opportunities and the process of growing. The process of 1031 is to grow your wealth faster because you're avoiding the tax and you're able to transfer the money that you would pay in tax into new property or more properties so that you can grow your wealth faster. Right, ladies?
Yep.
Yeah.
Okay, so taxes faced by the real estate investor. What are you going to pay if you sell a property that you've owned for a number of years? Well, there's the federal capital gains rate, which is either 15%, 15 if you're in any tax bracket other than the highest tax bracket. If you're in the highest tax bracket, then the federal capital gains rate is 20%. The highest bracket starts off at about $670,000 if you're a married couple, and maybe $620,000 if you're filing separately. Then, of course, there's a second federal tax called the net investment income tax, and that is 3.8%. We've also got the Massachusetts state tax. The one on the far right is called the Massachusetts state income tax, and that's about 5% this year. And then we've got the Massachusetts state millionaires tax, So if you're making more, if your income is over $1 million, then there's an extra 4% that's tacked on to the 5%. So you would pay 9% on all proceeds.
On every dollar over $1 million is the 4%.
Over $1 million.
Yeah.
Right.
So
that's
that one hurts a little bit. It seems like a lot of our clients have gotten into that millionaire's tax. Certainly not millionaires, but selling one of their biggest assets. And anybody that's owned a property in Massachusetts knows that properties have appreciated in value a lot, and many of them are going over $1 million, especially those multifamilies.
exactly.
So,
yeah. And then finally, there's the federal depreciation recapture, which is on the top left-hand side. It's called depreciation recapture, which means that you have the ability each year, and the IRS imputes depreciation. So regardless of whether you take it or not, you're going to have to pay the federal depreciation recapture tax, which allows the federal government to recapture the depreciation you've taken over the years. Now, if you're kind of foggy on depreciation, remember that it's the amount of money that you get to write off each year against the income. So you don't have to pay tax on the full amount of the income that you receive from your investment or rental property. You get to write off on residential properties 27, and you get to write off 1/27th each year of the value of the property when you bought it. And if you're depreciating commercial property, you get to write off 1/39th of its value when you purchased it each year. That offsets that much in income that you make in that particular year. So depreciation is a big reason why people like to invest in real estate, because they can make money and not have to pay tax on it through depreciation. But then the bad news, of course, is that when you sell the property, the IRS wants you to repay them for the money you've never paid tax on, and that's at 25%. So when you add the 15 or 20% capital gains, the federal 3.8% net investment income tax, the state tax of 5 and 4 over $1 million, you're looking at anywhere from 30 to 35% in tax on the sale of your property. Pretty significant, ladies.
yeah, it's a pretty big hit, and people don't want to pay that. So what we always talk about is how, like John said, if you reinvest, if you do a 1031 exchange, you can use all of your proceeds. You can save that 30% and roll it into a new property, and you're going to be 30%. You're going to have 30% more equity in that new property. So, and this is a good calculator that we can go through. And do you want me to take this one?
Sure.
Okay, go ahead.
Okay, so this is a good example of something very typical sale in Massachusetts. We're going to talk about what basis is, what the profit is, and taxes. So when you purchased a property, let's say somebody purchased a property 10 years ago for $500,000. They bought a nice little 2-family in Medford for $500,000. They put about $500,000 worth or $50,000 worth of capital improvements in the property. They put a new roof on, new kitchen. But then they took depreciation. They took, $15,000 in depreciation over 10 years, which was $150,000 total. So their basis now is $400,000. That means that anything over and above the $400,000, any profit that they make over $400,000 is going to be taxed. So they turn around 10 years later, they're going to sell this property now for $1.2 million. They're going to minus out their basis of $400,000, and then they can minus out the closing costs, that $80,000 for the realtor fees and the attorney fees and such. So now their capital gain is $720,000. That's pretty.
So Michelle, when you're thinking about current values of an appreciation in the last 2 or 3 years, that $1.2 million is probably really low.
Really low, yeah, because the 2 families and 3 families in Somerville are now $2 million and $2.5 million. So
sometimes $3 million.
Yep.
And so you're looking at a property you've only got $400,000 in, and you sell it for $2.5 million. You're going to take a huge tax hit. But you continue on. we're only taking a $720,000 capital gain on this one because it's sold for 1.2.
Right. And I think this calculator that we're the next few lines, I think this is where people always get a little bit shocked. So the recapture depreciation, we're basically going to take the 25% of this 150, which comes out to the 37,500. So the IRS is going to take 37,500 right off the bat, just that for the last 10 years. We calculated the federal capital gains tax at 20% in this example. So 20% of the 720 comes out to $114,000. We've got the NIIT tax, which is the 3% of, again, the 720, which comes out to 27,360. And then the Massachusetts state tax, which is 36,000. Again, we're going to do 5% of the 720, and it comes out to 215,000. So on that sale, that $1.2 million sale, they're going to pay $215,000 in tax. And most people would say $215,000 worth of tax is better off going into equity of a new rather than going to Uncle Sam. So that is kind of the shocking.
Well, the way I see it is that's 215,000 you could be reinvesting in another property.
Right.
That might even buy them a one-bedroom chalet up in the mountains.
Possibly. Yep. So
maybe a studio.
Probably a studio. But, in the next slide, I think Sarah can take this one, but people seem to think that exchanges are so difficult and so much more work and something really for the wealthy. And a forward exchange is even though it's a complex process, we simplify it, and it really is easy for our exchangers to execute an exchange and defer their taxes. And this is really the step-by-step on how it works. And Sarah can break it down.
Right. So you have we're the qualified intermediary, of course, in the middle here of this chart, and the original 1031 tax exchange back in the day when taxes were implemented in this country, it was a direct swap, and so a buyer was selling to a seller and seller was selling to the same buyer. But we are now able to do where you don't have to sell directly. You don't have to do a swap. You can hire an intermediary to do the swapping for you. And this is breaking down that on this slide. So the seller, we are the taxpayer. And so, we're the qualified intermediary, and the seller will act as, handling the 1031 tax exchange. So you're selling actually to the qualified intermediary, and then the intermediary is acting as the seller and then selling directly to the buyer. And then there's just a direct deed process. So we don't even have to go on the deed to the property when you sell or when you buy. And so we just handle the funds in the middle process. So when you sell your property, the funds go to the qualified intermediary. And then when you purchase from a seller, then we send those funds directly to the closing attorney on your purchase side. And then the deed is recorded on your purchase side, and the entire 1031 exchange process is complete. And just like that, you've deferred 30% of the tax that you would have paid. So it is simple, as Michelle stated. You're just selling one and you're buying another one, and you're using us as a qualified intermediary. You do have some restrictions on your when you can buy. So you've got 45 days from the date of the closing of your relinquished property to identify what you want to buy. And there's a couple different ways to ID. We can go into those later. But the easiest one is you can name up to 3 potential replacement properties. And on that day, you're locked in on day 45. And then you have an additional 135 days or 180 days total from the day of the closing of the relinquished property to close on it. Closing, that's a long time to close, of course. And so it's just really the 45 days that you've got to be out there shopping every day for your replacement property.
And I always tell the exchanges. That's really the hardest part of the whole exchange. I think that 45-day window to identify a property is really the hardest part. But what we've been seeing, especially in this time, or, in this market, we've been seeing most oftentimes when people take a contract on the property that they're selling, they have a contract now in hand, they're going out and shopping for their replacement property immediately. So they have some time leading up to the closing of their actual sale. And then they have 45 days after their sale to go out and solidify a purchase.
Great point, Michelle. So really they have more than 45 days. They have 45 days after the closing of the property they're giving up. But once they've taken a contract on the property they're selling and the contract goes hard, or in other words, the seller can't back out without losing money. Excuse me, the buyer can't back out without losing money. Then you've got that time, that lead up time to the closing that you can add to the 45 days after the closing. So in a lot of cases, buyers are getting financing, and it takes them 30 to 45 days for the financing to occur. And so that gives you another 30 or 45 days in addition to the 45 for shopping. And you can start making offers on properties anytime, even before you close on the relinquished property.
Right.
Oh, and just as a sideline, if anybody wants to click on their video, we would love to see you. You can click on your microphone and ask a question anytime. We've got a fairly small audience here. Number of participants is small enough where we can handle, working with you and making this a little more interactive rather than just a webinar. Okay. So 45-day must identify potential replacement property by the end of the 45 days. We kind of act as your coach and your cheerleader. So we're looking for you to have a replacement property under contract by the end of the 45th day. It doesn't have to be under contract because you can name up to 3 properties regardless of whether you have one under contract or not. The problem with that, though, is
you can't change your ID after the 45th day. So you want to be pretty sure that whatever you ID by the 45th day, you're going to be able to get. So that's
the only way to be sure that you're going to get it is that you have to have an offer to purchase accepted.
So it's not a requirement to have a purchase and sale by the 45th day. It's just recommended.
Right.
And remember, both the 45th day and the 180th day are both calendar days. So we have one that's closing, literally supposed to be closing on Sunday, and they have to close by Friday.
Because Sunday is their
180th day. So there are typically no extensions or exceptions. If you identify properties on the 45th day and the seller backs out, or there's something wrong with the property, there's no extension on that 45th day.
Not even death.
Right.
You can die.
Yeah.
And your heirs still have to identify.
And the only time we see exceptions is when there's like a nationally declared emergency or state of emergency. We saw it at COVID. We saw it during the hurricanes. So you see it once in a while where there's like a federally declared disaster area and the fall within that disaster area. But otherwise, hard days, and make sure that if your 180th day falls on a holiday or falls on a Sunday, you have to close on the business day prior.
Okay, so this is kind of the identification process. To further dig into that, we were discussing there's a 3 property rule, so you can ID up to 3 potentials without regard to value, and list those on your identification form. If you want to list more than 3, you just cannot exceed 200% of the value of your relinquished property. So if you sell for $1 million, you can list, several properties up to $2 million. And then we've got the 95% rule, which is more for if you're buying portfolio of properties. So you can, if you wanted to go above the 200% value of your relinquished property and exceed 3, then you just have to acquire 95% of the value of the properties that you've identified.
Okay, so now this is where people get confused.
They mix up the two rules, the first two.
The first two rules get mixed up, and people say, oh, well, I can't identify more than 200% of the value of my relinquished property. So I sell a property for $1 million. I can identify up to $2 million if you want to. And
here we go.
Now, are we back?
Yes.
Yeah. Okay, so I think if we got interrupted, what I was saying was that the 200% rule becomes confusing to some people because they think that they cannot buy a replacement property for more than twice the value of their relinquished property. I'm hoping I'm making sense. That's on the 200% rule. And the 200% rule is there only for the purpose of diversifying. If you're trying to buy a lot of smaller properties and diversify your investment. So let's say you sell one property for $1 million and you want to buy 5 $200,000 flats or condominiums or lots, individual building lots, let's say. So you want to spread out your investment from one property to multiple properties. Then you can use the 200% rule, because the 3 property rule would not allow you to buy but 3 properties maximum. So the IRS said, okay, well, we'll throw in a second rule, which allows you to diversify and buy a lot of lower price properties up to 200% of the value of your relinquished property. Again, on the 3 property rule, let's say you had paid off your mortgage and you had $1 million worth of equity from the sale of your relinquished property, and you wanted to leverage up. Michelle,
Yep.
If I wanted to leverage up because I'm young, I'm trying to make my mark, I want to take that $1 million and buy 3 properties and put a down payment of $333,000 each on $3 million properties. Now I've taken a $1 million property and I have turned it into $3 million properties. So now I've got 3 properties working for me. I can get 3 times the income next time I get ready to sell in a couple or 3 years from now.
Yep.
So a lot of people do that. Now, when you get old like me, Michelle's going, I can do that. I do that all the time. And I'm going, well, when you're old like me, you probably won't want to get that financing. But, that's based on the stage that you're at in your financial career.
It's a great, it's a good strategy. And people have reasons to exchange. Everybody has a different reason to exchange. Every single person that we talk to.
Mm-hmm.
So let's
just for a different reason.
Yeah.
Exactly.
So.
And these are
Yeah.
these were the
reasons. Yeah, these are the reasons.
Okay.
People.
That was a good segue.
Thank you. The slides didn't wear not coming that way.
So that's what we were talking about first, was leverage.
Yeah.
I want to leverage up because I want to spread out my equity over more properties so I can take advantage of more opportunity for appreciation.
Typically the younger people, the ones that are eager to build their wealth quick.
And then we've got diversification. I mean, that's what we're trying to do is, we talked about the idea of maybe we try to spread out. Instead of having just one property, we're going to get multiple properties. Consolidation, just the opposite.
Yep, consolidation. I mean, we have people that have been buying properties all across the city and say, you know what, the management's just too much right now. And I want to consolidate. I want to sell them all. And I want to be able to put them into one big apartment building or one big commercial, triple net lease property. And you can do that. That's what's really nice. You can sell multiple properties and put them all into one big property, and use 1031 exchanges on all of that, on all of the smaller ones.
Reduce your headaches from multiple to
just toilets and trash.
That's right. Yep. And that goes hand in hand with the management relief. And usually that increases their cash flow. So we had one client that we were talking to today and wanted to make sure that, her property wasn't cash flowing well. And she wanted something that would be in a better location where she could get higher rents and increase the cash flow.
and maybe a quality of tenant, or just
right.
the opportunity for less management headaches. Cash flow is a big reason why people decide they would like to switch properties or exchange.
We talked about depreciation, but estate planning really is like one of the ones that we get a lot. People have multiple heirs, and they want to get that stepped up in basis for their heirs after they die. So estate planning is a really great 1031 exchange is a great tool for estate planning. And we can do a whole segment on, we've done a whole topic in a whole 1 hour session on estate planning with 1031 exchange. So it's a lot to get into, but it's certainly a topic that we could dive into pretty deeply.
Yeah, I think an additional one that is often used is if people move from one state to the other. So if they're moving from California to Boston, or Boston to Florida, and their investments are located in the prior place that they were living, they can exchange into properties near where they are currently located. And that's very helpful for people to be able to look after their places after they move out of the state or area.
Yeah, and going back to that estate planning thing, we have a little slogan sometimes. We say, "Drop until you swap."
Swap until you drop.
Thank you for the
swap
question.
until you drop.
So the idea there is, you don't want to just liquidate your real estate assets, because you decide you want to just get out of real estate because you're older and you enjoy retirement, right? You want to enjoy your retirement, and you don't want tenants calling you up on what?
Tenants, toilets, and trash and all that. Yeah.
So
yeah, and the thought is well, I might as well just pay it now, because the tax rate might go up, but you never know.
Yeah, you don't know, number one, and number two, why would you pay it if you could
don't
avoid
have to?
paying it? You could buy investment triple net lease properties. You can buy triple net lease properties. You can buy Delaware statutory trust. We'll talk about that maybe in a minute. And there are other types of real estate that you could buy where you won't be involved in day-to-day management when you're in that stage where you want to just be retired.
Yeah, Gregory is asking a question, and I think we're definitely going to talk about DSTs a little bit more and Delaware statutory trusts a little bit more. And that's certainly a good option for some people. And
I call DSTs the opportunity for mailbox money.
Yeah, absolutely. They're hands off, and they definitely work well for some people. So we'll get into that just in a few minutes, Gregory.
So the exceptions, what can you exchange and what can you not exchange? You cannot exchange your personal residence. Your personal residence falls under Code 121, and you get to exclude $250 if you're single, or $500,000 in profit. And you don't need to exchange. That's strictly on your primary residence. Strict vacation, second used for personal use, are not exchangeable. It's good for us to talk to anyone that has a second home or a vacation home, because generally when they're ready to sell, they've limited their personal use in that property, and are renting it out a little bit. And technically, even though they call it a second home or a vacation home, it might fall under investment, and we can exchange it for them. So stock and trade or other property purchased primarily for quick resale, so flips are not exchangeable. Stocks, bonds, or notes. Other securities or evidences of indebtedness or interest in a partnership. So if you cannot buy into an LLC, you have to buy into the underlying real estate. So you have to go on the deed as tenants in common. You can't buy into a LLC that owns the property. Certificates of trust or beneficial interest.
Non-exchangeable items.
I think we kind of touched Certainly.
So a two-party swap is just a straight, you've got a property I want and I've got a property you want, and we just exchange. No need for a qualified intermediary because you're doing exactly what the code was originally intended for, was to swap property with someone else. It's like finding a needle in a haystack for Michelle to have a property I want and for,
Mhm.
I want to buy her property. So that's why the qualified intermediary came into the picture. Delayed exchanges with a qualified intermediary are what we call standard delayed exchanges, where you're selling one to one party and buying one from another using a qualified intermediary to be the person that you swap with. Multiple sales and acquisitions. Reverse exchanges. We might touch on that a little bit.
Those seem to be very popular right now.
Yes.
In our world.
Yes.
Exactly. And it's because it's so easy to sell a property, but it's more difficult to find something that you really want to buy. So a lot of people will shop to begin with and find a replacement property. They can't just put it on hold because it won't be available when they do find a buyer for their property. So they have to go ahead and purchase the replacement property in advance of selling the relinquished property, and we call that a reverse. And we have to set up a qualified parking procedure, which allows the exchanger to park the property in a special purpose LLC that we form called an Exchange Accommodation Title Holder LLC. And we park the property in that LLC while they're trying to market and sell and close on their relinquished property. Now, that LLC has to be formed as a separate entity. It cannot be owned by the client. It has to be owned by the qualified intermediary or a derivative of the qualified intermediary, and the exchanger will have the full rights to use the property and receive income from the property while it's being parked. But it gives them the opportunity to then, after they've found that perfect replacement property, to put their property on the market and sell it within 180 days.
That's right. Yeah.
So that's called a reverse exchange. The improvement exchange and add to it. So you might want to buy a fixer-upper and then use some of the equity from the sale of your relinquished property towards fixing it up. The downside of that is that you only have 180 days from the date of the closing of the relinquished property to make all the improvements that you want to have tax sheltered.
So you need to have your permits in place and ready to hit the ground
Right.
as soon as possible.
Right. Yeah, and those are great for the quick, maybe like we're going to just replace a roof or we're going to just do a kitchen. Yeah. So doing a whole rebuild is a lot more difficult in an approved exchange, but you know, you can certainly.
Trying to buy a lot and then build a house on it, you would have to have everything ready, and then you're depending on how much you're going to put into the new place, can you get it done in 180 days? And in this day and time, it's very, very difficult.
Yep. So talked about that. So, I think we get this like-kind property myth a lot. People ask all the time, if I'm selling a residential property, can I buy a commercial property? Is that considered like-kind? Or if I'm selling a condo, can I buy an office or a piece of land? And really, it's just a myth. Like-kind just simply means investment property for investment property. It doesn't matter what the grade is. So you really can exchange any type of investment property for any other type of investment property. So you can certainly do a single family into a commercial property into a farmland, single family into a multifamily or a motel or a hotel. It really doesn't matter.
Any kind of real estate is like kind of any other kind of real estate.
That's right.
Now, where it comes in like kind, it has to be investment property. It can't be an investment property for a primary residence.
That's right. Yep.
Could you sell an investment a house and then buy a rental and rent it out for 2 years and then to move into it as your primary.
Yes, absolutely. That brings up a good point, Sarah. So let's say you sell an investment house. You know, this 121 primary red tax exemption brings up a real issue right now, ladies, because, you know, a lot of properties that were bought a few years ago for $200,000.
Exceeding this.
And you're only going to get tax exempted if you're married for up to 500,000.
Right. And this, again, this is on your primary residence. So if somebody has a primary residence that exceed a $500,000 increase in value and want to sell it, they're going to be stuck with, they're going to have a tax burden there. So they do have an option. They could turn around and rent it for 2 years.
Yeah, this is the great tax escape, right?
Yeah. And then move into a new primary, but not sell the old primary, turn it into a
right. And then you can utilize the 121 tax code, which we have up on our screen right here, as long as you've lived in the property for 2 of the last 5 years, and you can combine the rest of it with the 1031 exchange. So, you know, if you have a $750,000 gain in that property, you can use the $500,000 tax exemption, and then you can do a 1031 exchange for the remaining portion.
Pretty neat.
Yep. As long as you do it within those 2 of the last 5 years of living in that property. So
that's combining a 1031 and a 121.
Yep. So I think, is that the slide? Yeah. So I think that's the slide on it.
Yeah, allows you to combine both, so you can actually pull cash out and you can 1031 exchange, but you have to have lived in it for 2 out of the last 5.
That's right.
So, you know, a lot of times we advise clients to, if they're going to be having to pay tax on their primary residence because their gain is going to be more than 500,000 or 250 if you're a single person, then take that property, turn it into a rental for 2 years. That means you're going to get income for 2 years from it. It's going to continue to appreciate in value for 2 more years. And then at the end of 2 years, or maybe even closer to 2.5 or closer to 3, if it's in a hot market where you know it's going to sell quickly, then you can put it up for resale at that point. As long as you've lived in it for 2 out of the last 5, you can pull 500,000 cash out. Let's say in 2 years, it's worth another 250,000. You might be able to 1031 exchange a very substantial amount into a new investment property and take 500,000 out in cash to help reimburse you for the money you had to lay out to buy your new primary residence 2 years ago.
It's a great tax strategy. Unfortunately, I personally don't get too many calls with people that are selling their primary residence. 1031 exchange isn't typically a conversation that their CPAs or the realtors or their attorneys are having with them. So it's important to know that 1031 exchange can happen with primary residence with the proper steps to be taken. So
any questions so far? Any more questions?
We've been getting a few questions, and Joe Bonavita, who also works with us.
We got a hand raised.
Yep. He's been working through our chat and our questions. But SM, if you have a question, so I know Parisa has a question. Oh, hi, Parisa. I know you have a question about how mortgages is handled with 1031 exchange. So with the mortgage, so your goal whenever you do a 1031 exchange is to buy, the first thing is that you want to buy equal or greater in value for a replacement property. And the second thing is that you have to use all of your exchange proceeds. Now, if you have a mortgage on the property, let's say you have a $1 million property, you have a $200,000 mortgage, you're really only going to be walking away with $800,000 in cash. Now, when you go out and buy a replacement property, you have to buy $1 million property
to defer all
the tax. So, but you don't necessarily have to take out a mortgage. If you have $200,000 in your savings account that you want to pull out and add, you can certainly do that. However, most people have to take the same amount of mortgage. That's usually what people do, to buy equal or greater in value. And you will be taxed. Let's say you bought this property, you bought that $1 million property that you're selling, and you bought it for $500,000 10 years ago or 5 years ago or whatever. And now you have a $400,000 mortgage. Well, your gain is going to be based on what you purchased the property for. The mortgage doesn't really matter.
You could have refinanced a year
Right.
ago and pulled out all your equity.
Tax-free.
Yeah,
So
the IRS doesn't care if you have a mortgage or if you don't have a mortgage. They're just going to be looking at what did you pay for, how much did you pay for it, how much did you sell it for, the difference.
Yep. So we have a lot of people that bought a property for 500,000. It's now worth $1 million, and they have a $900,000 mortgage on it. And then they go to sell it, and they only have $100,000 worth of cash. Well, you already took all the money you already took the equity out. So that's going to be a taxable event there.
Now you're going to have to mortgage up again.
Yep.
Of course, people don't like the idea of having to mortgage up on higher rates now.
Right, right.
So,
Parisa, I hope that answered your question. And if it didn't, we can certainly get into, you can give us an example and we can certainly answer that for you. And SM, I know you have your hand raised. So if you have a question, you can feel free to, you can't unmute. Oh, let me see if I can unmute you. Allow mic.
Cool.
Okay, let's see if that works. Oh, there we go.
Yes. Thank you so much. Thank you. Hi, Michelle. This is Isam.
Hi.
We actually did sell our first investment property through a 1031 exchange with you, and it went very well. And we now have a second property that is also appreciating. And so I want to thank you for your help. It was really a very smooth process. No doubt a bit of the anxiety about the timing and finding the property and so on, but it went very well.
Thank you.
The question I had, I think you touched on it a little bit earlier, is one of the attendees, I think, touched upon it, was, our second property, we probably will eventually also sell that and purchase as I think mentioned earlier, to upgrade it to maybe something that'll give us even more higher rent and more cash flow. But in a few years, we might, and we'll choose the property based on something we might like to live in eventually when we retire. So if we do end up on the third property we purchased through the 1031 with you guys, if we end up living in it after that, would we be liable for the taxes that accumulated over the two sales, or am I mistaken? Thank you.
Yeah, that's a really good question. So the IRS doesn't have any hard and fast guidelines on how long you need to hold a property for investment purposes before you sell it or before you turn it into your primary residence. However, we would always recommend that you give it 2 years of renting it before you move into your primary residence. That's just shows the IRS that you've held on to a property for 2 years for long-term gain. But the IRS is truly looking at your intention. There are cases that have been tried that have shown that people have moved into rental properties after only 6 months. And because they intended to hold the property and they can prove their intent that they intended to hold the property for long-term gain, and they had extenuating circumstances, the IRS allowed the exchange to happen, even though allowing them to move into the property. However, best practice, wait 2 years.
Yeah, buy it, rent it out for a year, rent it out for another year, and then you can move into it.
Right.
You have no tax consequence.
Yep. Now, if you go to sell that property as a primary residence, you remember you brought your basis over. So you did bring your basis over from your relinquished property into your replacement property. So your cost basis is lower. And you can take advantage of the primary residence tax exemption after you've lived in the property, but it's going to be prorated to the amount of time from when you've owned it as a rental to you owned it as a primary residence. So now if you've owned this property for 20 years and you only rented it for 2 years and you lived in it for 18 years, well, you're going to take a lot more, a higher percentage of that primary residence tax exemption.
So let's take an example. Say, Michelle, let's say I took an investment property, bought a replacement property that I rented out for 2 years, and at the end of 2 years, I move into it. So now the IRS says that you can live in it for another 3 years and or more. And if you live in it for 3, let's use that as our example, after you've rented it for 2, you've owned it for 5, and you've lived in it for 3, so you get 3/5 of your primary residence exemption. Now, this is taking it a step farther from what you had originally asked, sir. You said, can I move into it and not have to have the tax clawed back? And the answer was absolutely, you can move into it, wait for 2 years, and then move in, turn it into your primary residence. There's no tax. Now you lived in it for 3, you decide to sell it because you want to downsize maybe again. So
Right.
now you're going to be able to sell it. You're going to be able to take 3/5 because you've lived in it for 3 out of the last 5 that you've owned it. So you'll be able to take 3/5 of the $500,000 exemption if you're married. So now you get to write off the first $300,000 in profit. The problem is what Michelle was saying was that you carried your basis over when you bought that property from your prior property. And so your basis on the property may be very low. And if you have a
Mhm.
property, you only have a basis of 200,000 and you sell it for $1 million and you only get protection on the first 300,000, then you're still going to have a
Right.
whopping tax bill.
Right.
So if you move out of it, you probably aren't, you can make that analysis. That's an easy analysis for you to run, right?
Mhm. Mhm.
And then if it looks like you're going to still have to pay a lot of tax, then you just wait for 2 years to sell that one again and turn it back into a rental. And then you can sell it and not have to pay the tax.
So we have a couple other
do this.
questions. Oh, sorry, Isam.
Go ahead.
No, that makes a lot of sense. And that last part, I sell it as through a 1031 again.
Yeah,
Yeah, exactly.
Perfect. Perfect.
Exactly.
Perfect.
Swap until you
Thank you
drop. You're welcome.
Now, when you drop, we say swap until you drop because when you drop, your heirs get a stepped up basis on all the hard work you've done over your lifetime.
So that's the question that Greg has actually. So Greg's question is, can we discuss stepped up in basis?
Right.
So yeah.
Greg, let's unmute your microphone and let you ask us again about that.
See if I can.
There you go.
So Greg, you're unmuted as well. And if anybody else wants to unmute, just raise your hand and I can unmute you. So Greg had a couple quick questions.
Thank you for that. Can you hear me well?
Yes. Yes, sir.
Hi, are you able to hear me?
Yes, sir, we are. Sounds like he's having trouble hearing us.
Yeah.
Okay. Well, Greg, the idea, I think you're saying, can we discuss step up in basis? And the idea is that upon your passing, your heirs' basis in your property that you leave them will become the value of that property on your date of death. So if when you pass, the property that you are holding for your heirs to be able to have and enjoy, then has a basis. You may only have a very, very small basis in it because you've depreciated over the years. But when you pass, then that basis becomes its current market value at that time. So if they sold your house after the funeral, then they would have no gain because they would be selling it for its current market value. Now, if they hold on to it for a few years and it continues to appreciate in value, then they might have some tax, but it would only be on the difference between its value on the date of your death and the value when they do decide to sell it later on. So step up in basis is just a wonderful opportunity. And, that just goes back to why people like to invest in real estate, because, the founding fathers felt like that if you owned real estate, you made a better citizen. And so they gave you all of these opportunities and exemptions from taxes so that you could afford to own real estate sooner than later. And so that one of those benefits is that step up in basis, because you don't want to feel like that you've worked all of your life for property and then to pay off property. And then when you pass, your heirs are going to have to pay all of this tax.
Right. And it becomes a burden. So if they didn't get the stepped up in basis, properties would be a burden for people.
What
for heirs.
happens? What happens so much, Michelle? You tell me if you're not hearing this all the time. People call and they say, look, I just want to go ahead and cash out or I'm going to go ahead and give my property.
Yeah.
No, don't gift prior to death.
If you give your property to your children a year or 2 or 3 before you die, then they're going to continue to have the same basis that you had.
That's right. So it's certainly, it behooves you from an estate planning standpoint. And again, this is just obviously always talk to your attorney, because people have different reasons for estate planning and different reasons for doing different title changes to their properties. However, strictly from a 1031 exchange standpoint, if you leave your property to your heirs and they are not on the title when they die, they inherit it, and they inherit it the value, the market value of the property, and they inherit that stepped up basis. So it is a much better, less tax burden or no tax burden for your heirs. So Greg, I hope that answered your question about stepped up basis. But the other good question that you had was talking about DSTs. So a DST is a Delaware statutory trust. And essentially what a DST is you are able to take your proceeds exchange from, you sold your property, you're in an exchange, you can invest into a larger property, a $20-30 million property, and you become a fractional interest share or fractional interest owner. So that's essentially what a Delaware statutory trust is. What the benefits are is that you become like John said earlier, it becomes mailbox money. You don't have the tenants, the toils, the trash, the burdens of owning the property. It really becomes an investment that pays you a dividend. So
I think the closest comparison would be like buying into a real estate investment trust or a REIT.
That's right.
If you're familiar with those are sold on the stock market. And if you wanted to invest in real estate, you could invest in a REIT, a real estate investment trust. The real estate investment trusts, though, are not 1031 exchangeable. Delaware statutory trust are, because Delaware Secretary of State decided that he wanted to create a type of LLC that would be a pass-through entity, such that you would, even though you don't own a tenant in common share of the property, you do own, it's a pass-through, like you were saying, Sarah. So you do own a fractional interest in that property.
Yeah, some of the, I mean, there's some benefits, and whether you see it a benefit or downside, that, it is a long-term hold. So you're typically looking at a 5 or 7 year hold. Because you don't have control over, you can't just go and sell your share. There's no secondary market for DSTs.
Definitely pros and cons to it,
Yeah.
no question. And it works really well for some people, and some people it's just not their cup of tea. But we'd like to at least give people the option and let them know. I know, Holly, you had a question about syndications. I'm going to unmute you. And if you have anything specific about syndications that you wanted to ask.
Which one?
So I was looking at Holly.
I
Holly,
think she's still muted.
Okay, yep, Holly, you are muted, but if you wanted to ask about syndications, I'm not entirely sure what that question was.
No, I guess it was just when you're talking about the DSTs, I was wondering if it was similar to syndication.
It is very similar. In other words, a syndicator or a sponsor will go out and buy a property, like an Amazon fulfillment center, or an apartment complex, maybe in Boston, or an apartment complex in Miami, or anywhere in the country, or a hospital, or a Walgreens, or or maybe a group of Walgreens. And that syndicator will then establish those properties under a DST form of ownership, rather than just a standard LLC syndication. So under that DST, then it becomes eligible for 1031 exchange money. And let me tell you, there are billions with a B as in boy, billions of dollars every month going into Delaware statutory trusts from people that are retiring and deciding they want to move out of actively managed real estate into more of an investment type vehicle. Rather than going into the stock market, they like staying in real estate, so they buy into Delaware statutory trust. The problem with Delaware statutory trust are that the syndicator decides when to sell. He has to sell by the end of the 10th year of ownership. So the syndicator may decide to wait 5, 6, 7, 8, 9, or up to 10 years to resell the property. When it resells, you get your share of the ownership based on your equity contribution when you buy in. And then you get to 1031 exchange again into another DST or into another wholly owned property if you so desire.
So Sean had a question as well. Sean, I did unmute you, so you can certainly ask the question if you'd like, but you were talking about what the risks were involved with the DSTs, which John just kind of went through. I think you answered.
Yeah.
Did that
And I mean,
answer?
real estate is, you're buying into real estate, and real estate, there's risk in real estate. So it's just your normal risk
Yeah, I
when you
mean,
invest in real estate.
what's the worst thing that can happen in a DST? You buy in,
And the value of the property
goes down.
or the tenant goes away.
Right.
The tenant and
Yeah.
the building goes dark.
Yeah.
Well, the good thing about it is that it's still there.
Right.
It's bricks
Still
and
bricks and
mortar,
mortar.
right? You can still kick the bricks, and it's not going to go anywhere. It may have to be repurposed. It may be vacant for a year or 2 or 3.
Yeah.
But you're not going to lose your value unless you're buying in some place that just gets, economically depressed.
Right.
Yeah, and these are cool for people that are looking to get out of active real estate. They're also neat for, if you have an amount of money, like you sell a $2 million property and you find a really great $800,000 property or $1 million property, you can buy that one replacement and then buy a DST to cover the rest, which is nice because then you can
Do a
defer
complete exchange.
Yeah.
And you can buy increments of as little as 25,000,
Mhm.
maybe sometimes 50, maybe sometimes 100,000. It just depends on the particular offering. If you Google DSTs, you'll see a whole world out there. The downside, the other downside that we didn't talk about was that you have to be what they call an accredited investor, which means that you have $1 million worth of net worth without your primary residence being included in that calculation.
So Greg, I know you had another question about ROI for the DSTs. They range. I mean, they can go anywhere from 3% to 5% right now. It's not guaranteed, so it really is based on the performance of the property. So they give you an idea of what they're expecting, and they expect that through the life cycle of that property, but it's not guaranteed. It's just like investing in any other. It's like putting money into any other investment.
Your monthly income can grow if the lease from the triple net lease fee has escalation clauses in it.
Right.
And sometimes they do. DSTs are offered by sponsors to be attractive, so they try to pick out properties that are inflation proof,
Right.
and
like Amazon.
internet proof.
Yeah, like is Amazon gonna go down in our lifetime? Probably not.
It
Right.
could, but
Yeah. It's not gonna. Yeah.
So now, we're not, here's the disclaimer. We are not trying to push Delaware statutory trust. That's just one form of investment. Lots of people say, look, I do not want to give up control.
Right.
It's like buying a timeshare.
Yeah.
What happens if I need the money? These are all legitimate questions. And, sometimes people are just like, well, I want to be able to sell my real estate whenever I want to sell it. Well, that's a product of the market too. I mean, you buy a piece of real estate, you're not guaranteed to have a sale when you want it, but in the market that we've been in for the last 10 years, you pretty much are.
You're guaranteed, yeah.
Yeah, but
So we're bumped up right against our 1 o'clock time limit. So, but we're not limited to 1 o'clock. So that actually concludes our presentation. If you see on our screen, you'll have mine and John's information. Sorry, Sarah, I didn't put your information on there. I didn't include Sarah's. I don't know why. Sorry. Sarah's information's not on there, but Joe has been graciously on the backside answering the chat questions as well. So feel free to reach out to us.
thank you, Joe.
Yes. So that is our presentation, but we are going to hang tight for a little while and answer any other questions that come up. And the, yes, Sean, the recording is going to go out right after this session. So you should be receiving that, and then we'll be posting that on our website as well. So everybody's going to get the recording as well. If you want to be unmuted, feel free to raise your hand or just pop it in the chat. And we can unmute you and have a conversation. Holly, thanks for attending. Appreciate it. Isam, same thing. We appreciate you all attending today. Thank you.
Yep, thanks so much.
There's a hand. I see one. He's got 2 hands.
Okay. Hello, Mike.
Jim.
Jim,
Johnson.
Jim, I'm going to allow you first, and then Teresa, I'm going to allow you next. So go ahead, Jim. You're going to have to unmute as well, Jim. Oh, hi, Dory. You're welcome. Let me see if I can unmute you. Teresa, if you want to, I have you, or Jim, are you there? Jim?
You're going to have to unmute on your side, Jim. Up at the top, if you see the microphone, if there's a slash through it, you can click on it and unmute it. Okay, well, sorry if you can't.
You can pop in the chat your question too, if you'd like. Teresa, are you able to unmute yourself?
Yes, hi, can you hear me?
Oh, hi. Oh, hi. Yes,
Yes.
now we can. Hi, Parisa.
I know that you already tried to explain my question, but I was hoping if I can give you the actual numbers and you can help me just to give me an idea in this specific transaction that we are about to do.
Sure. Do we have any?
Yeah, so we have a property, a commercial property that we bought in 2008 for 500,000. We are selling it for 1,450,000 today. There is a 200,000 depreciation that we already has been like written off from the taxes, and there is about roughly 400,000 that we've done improvement to this property, and about 70,000 in commissions and fees that we have to pay for this for selling this property, and there is a 400,000 mortgage that needs to be paid off.
200 in depreciation or 300?
I'm sorry, I didn't hear that. What was?
Did you say there was, you had taken 200 in depreciation?
Yes.
So her basis is 300. And how much have you made in improvements?
Close to 400.
Okay, so 3 plus 4 is 4, 5, 6, 700,000 is her basis.
Mm-hmm.
Okay, and she's selling for 1.45. And how much was the commission?
Well, here's the thing. It's a business and a real estate. The total price is 1.6, but I don't know how the commission fees is going to be. But the real estate part of it is, so there are going to be two PNSs. The real estate part of it is 1.45, and the
Right.
business is being sold for 150,000.
Okay.
But the
I'm
fees
glad-
are 70,000.
70.
So now you're just going to take the 700 from the 1450.
Bracer, I'm glad that you got that squared away. I know last time we spoke that those numbers weren't finalized yet.
Yes.
So you've got a profit of about 700,000. If your expenses are going to be 70 for the real estate side, then you're really going to have a profit of about 680,000. Okay, so 680,000 in profit that you're going to have to pay tax on.
Okay, so now if we want to do the 1031 exchange and buy a property for, let's say, only $1 million.
If you're buying down, then you're buying down by 450,000. You will be able to subtract the $70,000 worth of expenses. So take 450 minus, so that'd be 380.
Yeah, you have to pay tax.
Okay, so you're going to have to pay tax on 380, better than paying tax on 680. But
Okay. But we don't have to necessarily take in a mortgage, right?
No, you can offset it with cash. If you're buying down by more than your mortgage.
What she's asking though is
We are
that
hoping not
if
to.
she doesn't want to take a mortgage.
Get a
she
loan.
wants to use-
So will it still help you?
But her boot will be the 380 now in mortgage boot. She'll have mortgage boot instead of cash boot.
Mhm.
You're going
So
to
that's
have
what she's asking.
you're going to have to pay tax on 380,000. Okay, so figure at 30% on 380. So you're going to have about 114,000 in tax.
So you need to have the cash. If you use all of your proceeds and don't take out any mortgage, you're going to have a tax bill of $114,000 and you're not going to have the cash to pay for it unless you pull it out of your own savings account.
I see. Well, in that case, if then we have to buy something for less than $1 million, right?
Right. Yeah.
Yeah,
And so
sweet
your
spot.
tax, there'll be a sweet spot
Mhm.
where, you can balance that off so that you'll have enough money to pay the tax.
So
And
about
you're
like
just,
then.
yeah, probably around 900,000 would then give you enough cash left over to pay the tax.
Mhm.
Which might
Okay.
be if you're trying to get out debt free, then that would be the way you'd have to do it.
Mhm.
The other idea would be to buy on up in value and take a mortgage out on the replacement property.
Yeah, if you take a mortgage on when you buy a replacement property, it's not taxed. So that's a good way to get cash out.
I know that's the ideal situation, but I just don't think we would be qualified for a mortgage because I mean, this property that we are selling, this was our income producing.
Yeah.
So by selling it, I know we are going to buy like a multifamily, but I'm not sure if the bank would qualify us for a mortgage. That's
Yeah.
the thing. That's why we were trying to avoid getting a mortgage.
Understood. So you'll still the 1031 is still going to be of great advantage to you because
Your basis is so low.
your basis is so low. You're going to have almost 700,000 that you're going to have to pay tax on. And if you buy that replacement property, around 900,000, then you're still going to be saving a lot of tax money.
Okay, but just to sum it up, so if we buy something for around 900, we still have to pay that 114,000, right?
You will. Absolutely.
Okay.
If you buy something for 900, you're going to have to pay a little more than the 140.
But you'll have cash to pay it.
But you'll have more cash to pay it with.
Mm-hmm.
So
I see.
remember what you're going to be, what your target is 1,380,000. 1,380,000. So if
In
you
order
buy,
not to pay taxes.
right, in order to pay no tax. So anything you buy down by then is going to be taxed.
Okay.
So if you buy to 1 million, then you're going to have tax on 380. If you buy down to 900,000, you're going to have tax on 480.
I see.
It's 33 more in tax, but you're also getting 66,000 more in cash to help pay the tax with.
Yeah, one quick question.
Okay.
Chris,
Okay.
I hope that helped. We can certainly talk offline too as well. If you have any more specifics, we're happy to kind of go through that with you and go through some scenarios.
I hope that was a good example for everybody else too, because it allows, you to kind of think about how that tax works.
Yeah.
So, hey, Jim, I did unmute you and I can't hear you unless you want to unmute yourself, but I enabled your mic. But your question is, after a 1031 exchange was made, does the tax liability allowance ever go away? I'm not. Do you understand the question?
Yeah, it doesn't. You defer it. I think you're just wondering if.
It goes away when you die.
Yeah, you
That's the only
just
time
that basis.
right. You're going to you can't eventually sell the property and pay no tax, because 1031 allows you to defer the tax until you cash out. And then when you cash out, you're going to have to pay the back tax that you didn't pay. So there's no way for you to hold a replacement property and eventually cash out and not have to pay tax. I hope I'm answering your question there. And again, your microphone, you have to unmute your own microphone by hitting that microphone icon at the top of your screen.
So Jim, I hope that answered your question, but we've got another one that we're going to answer as well. Hi, Dory. I have a question about the 14 days you're allowed to be at the replacement property. The property needs, oh, this is a good question. Property needs repairs to make it a rental at market value. Can my husband, who's not on the title, do the repairs, but can he stay there and do the repairs? This is a great question. So what Dory's asking is about a vacation rental. And we didn't go through this because we kind of ran out of time. But there is a safe harbor, and I have it up on the screen right now, that says that you can use the property. You have to restrict your usage to the property for 14 days or up to 14 days per year for the first 2 years with a vacation rental. And the IRS is just trying to create a safe harbor to give you the difference between what a vacation rental is and what a vacation second home is. So great question, Dory. The 14 days is specific to vacationing. It's specific to being there, recreating and enjoying the property and not doing any work. The days that your husband needs to be there, or even you need to be there, that you're working on the property, those are not included in those 14 days. You can certainly use sleep at the property, work at it all day, get it ready for the rentals, and that doesn't have to be included with 14 days.
Anybody if one person in your family is working an 8-hour day, the whole family can stay there, and that day is not counted as a personal recreation.
Yes, so your husband can do all the work and you can go to the beach.
Or to the ski slope
Yeah.
if you're in the mountains.
So Dory, just make sure you keep receipts. We always encourage people to just keep receipts, keep a log, make sure you kind of have it jotted down. So if there was ever a question on the amount of usage, you have a log of what was done and what was happening at the property on those days.
I advise people to keep that old-fashioned pocket calendar that you used to carry around years ago, and keep it in your car pocket or in your suitcase. And then when you're there at the property and you're working, you make notes about what you were doing during that time frame. And you can stick receipts from the hardware store into that same little folder and just keep that. If the IRS audits you, then you can prove that you were there those days working, and they will accept that because they like for you to keep records.
And you don't have to you can be managing the work, hiring it out to other people. So you can be there managing the people that are actually doing the work as well. That counts.
Good.
That's a really good question, Dory.
Yeah.
Any other questions that we have? Again, I'm happy to unmute you. feel free to pop it in the chat. Going once, going twice.
Okay.
You have all of our contact information, so I'm going to just pop that up on the screen one more time. And if you have any questions, you can reach out. There we are. So we appreciate your time. Thank you so much. Oh, unmute me, please. Dory, I thought I did. Let's see. Oh, Dory, I did enable your mic, but you have to unmute yourself. So you have to actually go up to the mic where it has a line through it and click on it. I don't think I can unmute you, but I enabled your mic.
Hello.
Oh, there you are.
Oh, hi. I'm
Hi.
finally unmuted. I just want to thank you. You guys are the greatest. And I really appreciate everything you did to help me. But I just have a couple of questions, and I don't want to take up more of your time. But you know, if I'm staying at the property with my husband and he's working, and can we also keep some personal belongings there after we rent it out? Is that allowed? I would think it would be, because like a car, for example, and a 3-car garage, because we only need to rent out 2 of the garage spaces. That would be an example.
Yes. So there should not be a problem with that. The only issue there might be that the IRS could say, well, that portion of the property you were using for personal residence, so you need to subtract some small amount for that being used, for that not being used as an investment property. I think that would be far-fetched. And as long as you don't violate the spirit, if you're keeping half of the property vacant because you want to keep that for your personal, for you to come down and stay in while you're renting the other half of the property, then you're going to have to allocate a portion of the property to you as a second home and part as an investment property. But
No,
as long as, go
no,
ahead.
that's not what we were going to do. It's just that this property is a 3-car garage, and we think that it's better for us if I just keep a car there, and have it, not operational with our,
Yeah.
insurance.
Yeah.
That would be it. Maybe some bins in the attic or something like that. But we would not be staying there after we would rent it out.
And all of this goes away after 2 years anyway. After the first 2 years of ownership, you can
Right.
you can use it as much as you like or as little as you like.
Right.
But during those first 2 years, if you were just storing some equipment on site because it was easier for you to operate and maintain the property because you had your own car there and you could, when you came, you could maintain it easier, then that shouldn't be a problem.
That's good. But I think that's probably enough for today. You guys have gone over time, and I
Thank
do
you.
appreciate everything you all have done.
Thank you for the question.
Thanks, Dory.
Thank you. Thank you.
Okay.
Great. Thank you, everybody. I think
We're going to
sign off. We're going to sign off. Enjoy your day, everybody.